We start off with the cracks in the market spreading. That's right. You've got semis getting slammed after Nvidia's disastrous earnings report takes down tech darlings. Plus, retail is starting to fall apart, and we're starting to see high-yield bonds deteriorate. Two things that were holding up well while the rest of the market sold off in October. So are these cracks about to break the market? Just how bad could things get? Dan, Nathan.
Yeah, so I really like how you framed the question. It really is about the market. It's not as much about the economy. There's a lot of these sectors that you could have looked at, like semiconductors that you mentioned, that topped out way earlier in the year, back in March. And we saw some weakness in home builders all year. We saw the banks top out in the first half of the year. And I'm not certain, when you thought about what GDP was that we just had in the middle of the year, that that was really indicative of what was going on in our economy. But you're talking about the market, and I think that's really important right now. And the most important thing I think is very clear is MAGA. It's the MAGA complex. It's the Microsoft, the Apple, the Google, the Amazon.
Where's the
and
hat?
I'm going to give Kramer a little nod. And Fed, too, because we started to see the breakdown in all of those stocks. And without that leadership, this market's not getting back to the highs.
But if the Fed stops, does MAGA and the rest of the breakdown stop as well? Is it hinging on that? Is it hinging on just the Fed? Is it hinging on trade? I think that the cracks and the things that were the last ones to fall, incredibly unhealthy for the overall market. Makes me worried that we're watching a bigger collapse than any of us probably had even thought would happen.
Yeah, I think it's more than, the Fed's part of it, trade's part of it, but also when you look at what the expectations are, guidance for the next couple of quarters, it's not as great as investors expected. And so the stock market is going to look out 6 months, a year ahead of time, and the stock market right now is saying, hey, wait a second, maybe this is good as we get. And we've talked about the fact that the bond market's telling a different story. Bond market tells you, you know what? The economy's pretty good. We don't have a lot of inflation. Economy's not so bad. Stock market, completely different story. GDP, as Dan brought up, that's a backward-looking indicator. We know that there was an inventory push ahead of these tariffs. So there are multiple factors here. And on the downside, the problem is nobody can find a positive catalyst at this point.
Tim, things getting worse, things getting better.
Well, I actually think that the market is telling us a little bit about the economy. I look at where bond yields are, 306 on the 10-year. That's 6 straight days lower on yields, and it's certainly telling you that the market is concerned about growth. The good part of that is if people believe that it takes the Fed back. But as I like to say, a growth scare is much worse than an inflation scare. And I think people are still concerned that the Fed is along a path until we hear otherwise. And therefore, I think this week was very interesting. Again, very important level, by the way, on the 10-year. That was used, that had been kind of the resistance level. It's where we've come back to settle in. If yields sell through 306 next week, that's an indictment. Yesterday's retail sales numbers were okay, but I think as we've talked about on the desk, you have a dynamic here where, yes, wages are better, jobs are aplenty, but the reality of higher taxes, higher rates, and certainly feed through on consumer prices is something that I think the consumer is grappling with right now.
This is an interesting conundrum here, right? Because the market's got a little testy when we approach 323 or so,
testy.
And now here we are going to the downside. If we slice through 3, then that's a problem of another magnitude, right, Dan?
We've actually discussed this, that if the Fed were to kind of pull back, what would that mean for the market? Would it be bullish for equities, just a more dovish stance? And obviously they've been raising a quarter point for a quarter for the last few years. I think it would be taken the wrong way. I just want to make one point about some of the action. You mentioned retail. I think this week the most important thing that happened in the equity markets was the reaction of Home Depot and the reaction of Walmart to earnings.
Macy's.
That should have been
Macy's, Home Depot, Walmart. Those were good. Okay, earnings, and they were greeted with Macy's off 20%, Home Depot off 7%, Walmart off 8%.
But what I think it's telling you is that literally on the anniversary of these tax cuts, as we get to it next month, that the U.S. consumer is like the last thing holding up the entire global growth story at a time where you have this headwind of trade that might make consumer goods here in America more expensive as the tax cuts are abating.
Tim.
But I guess, I feel the need to take the other side, not only because this is a show with usually a healthy debate. And I agree that there are some headwinds. And in fact, I'd like to think that when the tax deal was done and everybody said this is an ephemeral kind of an impact on corporate earnings, I don't think it was. I thought you actually front-loaded a lot of it. But to be clear, I don't think the economy's fallen off a cliff. I think the good news is that people are actually starting to question whether companies are going to grow. I don't think the S&P is going to grow at 7% next year. But right now, as I say, I think the dynamics are you have repriced a fair amount of risk. And I think equities are starting to get to a place where some of that is reflected in a positive way.
And so when you say repriced a lot of risk, that's risk from the Fed and risk from trade?
Well, look, I think the Fed, I think what Dan was saying, and I believe it, therefore I agree with, bad news is actually bad news right now. If the Fed steps out of the picture, I'm not sure that's what we really want to see. I actually want to see yields back at 3.25, even though where you started asking these questions, which was, wasn't that a trouble spot? Markets are getting testy there.
Here's a split screen. It's Grasso versus Tim.
Okay. Yeah, so I actually agreed with what you came out, your first statements, that when you look at that 2940 in the S&P and you look at where rates were, and now you look where rates are going, if rates continue higher, you have split Congress, no more pro-growth, no more lower regulation. We can't get back to 2940 anymore. The calculus changes for the S&P.
Well, taking a level on the S&P and equating it with where we are with taxes and the global economy, I'm not sure what to do. I do think Apple at 185, and Apple has been a big part of where a lot of people now feel the market has lost leadership, is a pretty interesting story fundamentally. I actually think Apple's a buy here. And I actually think that people on some level have overreacted to this concern about either shipments or this is stuff we probably knew about Apple 2 months ago when we loved Apple. So I think the good news is that actually markets have given stocks a bit of a beating here. And some of these companies are going to have a great holiday season. I believe that will be the case.
Well, and if that's the case, though, and to Tim's point, the way the markets come down, we have sold off an awful lot. There is a potential for some kind of a relief rally. That doesn't have to mean that we're going to new highs, doesn't have to mean that we're in a bear market, the bear market's ending. All it means is that sentiment right now is shifted to the one side of the boat. I agree with Dan that bad news seems to be bad news for the market, but as we know, sentiment can shift very quickly. I still think the Fed meeting in December is critical here, not because of what they do, but because of what they say. If they can do a dovish hike, meaning raising rates and kind of talk down what's going on, if the market is down at these lows, you have the potential for a snapback rally.